The California housing market is once again on fire as the median home price jumped nearly 7.6% in March to $791,490 from February. But that doesn't tell the whole story, as March's price year over year was down for the fifth consecutive month, declining nearly 7% from the $851,000 median home price that we saw in March of 2022. At the same time, we've seen California home sales decline nearly 34% year over year, with the sales price down nearly 1% on a monthly basis to 284,000 units on an annualized basis. So that means if we continued the current pace that we're on, we would sell around 284,000 homes in 2023, compared to last year when we were sitting at a 427,000 annualized basis. Now, before you run off and tell your friends that the housing market is crashing, let's talk about a couple of things that have changed since last year. The very first thing is the numbers that we're reporting are primarily closed sales that were happening in January and February, where interest rates were sitting above 6%, compared to an interest rate of around 4% from the previous year. In fact, in March, the 30-year fixed averaged 6.54%, compared to 4.17% in March of 2022. So what is still driving the California housing market? With interest rates up, with inventory levels lower, the number of sales lower, why are home buyers still jumping on the fence, buying properties, and driving the prices up? Well, that's exactly what we're going to dive into right after you hit the thumbs up. If you find any value in this video at all, it helps the YouTube algorithm push it out to more people like you and helps me accomplish my goal of helping home buyers understand the real estate market. And also feel free to subscribe to the channel to stay updated on everything real estate related. Now, I posed the question a moment ago of what drives housing. Now, we've talked about this many times in videos. You've heard it in Economics 101. It all comes back to supply and demand, which is the number of homes available for sale compared to the number of people that want to buy those homes. And we all know that the number of people wanting to buy those homes is down due to housing affordability, which is essentially being driven by higher prices and higher interest rates. Now, a lot of times when we talk about supply and demand, we don't really go into the detail of that demand. Demand is made up of two different parties. And what I'm talking about here is the willing and the able. There's a lot of people willing to buy homes. In fact, my phone rings every day from people wanting to buy property, but it's only those that are able to purchase homes and want to continue to purchase homes at the current prices and current interest rates that will continue to drive the market. And at the moment, we have more demand than we have supply. And that's why Redfin is reporting that demand is outpacing the limited supply, which is making some markets feel hot despite the lower number of sales. In addition to that, we have a listing shortage across the country. At the moment, nationwide inventory is sitting somewhere around 405,000 homes. And because of that listing shortage, it's stabilizing prices, keeping them from falling, according to Fannie Mae. In addition to that, buyers can't buy if sellers aren't willing to sell. So the lack of property on the market is actually hurting buyer demand to some extent, because there are buyers out there that want to purchase homes, but they're looking at the market, not seeing available inventory. In fact, I have sellers willing to put their homes on the market that are willing to sell their home, but they're looking at the inventory levels going, I don't want to sell my home and essentially be homeless or have to rent for the foreseeable future because I don't see any properties on the market that I want to purchase. In fact, that's why a lot of off-market sales are actually happening in the market. 3 out of the last 4 transactions I've done have been off-market sales, where I knew a seller that wanted to sell a property, but for one reason they didn't want to put their home on the market. And at the same time, I knew a buyer and or an agent that was looking for a similar property. And so we were able to put that deal on the market without ever listing it on the MLS, which is another reason that inventory levels are staying low. So how are we seeing the median home price jump nearly 7.6% in a month if there's a lack of inventory out there and a slowing buyer demand? Well, it's because we saw interest rates move lower. In fact, mortgage demand jumped as interest rates hit 2-month lows. And that's exactly why housing market data is suggesting that the market's downturn might actually be coming to an end. But here's the thing, as I mentioned at the beginning, this doesn't tell the whole story because remember, these numbers are reported in March and they're primarily from transactions that were happening back in January and February. So now we're sitting at the middle of April where we've seen nationwide reporting that inflation has actually eased to 5%. But alongside that, we've seen the 30-year fix climb to the highest levels that we've seen in nearly 2 months, currently sitting at somewhere around 6.5%. And along with that, we've seen mortgage app volume decline as interest rates started to go up. So there's less buyers out there looking to purchase homes as interest rates start to increase. So what does that mean for the California housing market? Is it going to continue to be on fire, if you will, and continue to post higher prices even in the face of higher interest rates? Well, as I mentioned a moment ago, what drives markets? A lot of it has to do with supply and demand. And at the moment, California housing inventory is sitting at 2.2 months of supply compared to 3.2 months in February. This is the lowest level of inventory that we've seen since May of last year. And the primary reason we're seeing active inventory decline because we're not seeing nearly as many new active listings come to the market. In fact, March was the largest dip in new home listings coming to the market since May of 2020. And that's exactly why we've seen the median number of days to sell a home drop to 19 days compared to 28 days in February. But with that, we have seen the sales price to list ratio actually improve to 99.1% compared to over 103% in March of last year. So in March of last year, homes were selling at nearly 3% over the asking price, whereas currently they're selling just under 100% of the asking price, which goes to show you that house prices aren't crashing. It's more of a stabilization across the board. Now, a lot of people out there like to point out San Francisco and Sacramento when they're talking about housing markets that are crashing, if you will. Well, I'd like to take a minute here and talk about some of those numbers. The median home price in March in San Francisco was $1.7 million compared to $1.465 million just a month prior, which is up nearly 16%. Now, a lot of you are going to point out that this year, last time, the median home price was sitting over $2 million. So it's a decline of 17%. That is 100% accurate. But here's the thing. When I talk about these numbers, I don't like to talk about the median numbers, even though I'm talking about it in the fact that prices have increased month over month. And that's largely because the median number is so easily affected. In order for that median home price to drop, you just have more sales happening below the median number. In fact, that's what brings the median number down. And that's largely due to housing affordability in many cases. And as housing affordability improves, you'll see that median number increase. But here's the thing. Don't pay so much attention to the median price, more so focus on whether or not you're comfortable with the payment that's associated with that price. But at the same time, here in Orange County, we saw the median home price rise to $1.25 million compared to $1.15 million back in February, which is an increase of nearly 8% month over month, with the median home price year over year declining nearly 4%. And at the same time, Sacramento increased their median home price to $500,000 from $499,000 back in February, which is an increase of just 0.2%, and they're still sitting down nearly 10% year over year. And why is that? It's because they've had a lot of inventory come to the market, especially in that lower price point, and that's essentially pulling the home prices down. But with that said, I want to take a minute here and talk about the Orange County housing market where I'm located here in Southern California. If you watch my other videos, you've heard me talk about how hot the housing market is. It continues to be almost crazy as every home that comes on the market that is priced correctly ends up with multiple offers and many times selling above the asking price. And as I've mentioned several times in this video, it always comes back to supply and demand. As of the time I'm filming this video, we're sitting at 2,065 listings here in Orange County, 3.3 million people. Now, that might not mean anything to you, but when you're comparing it to the 3-year average in mid-April, between 2017 and 2019, we'd currently be sitting around 5,780 homes, which is nearly half of where we are today. And at the same time, we have demand increasing, going from 900 pending sales to 1,663 pending sales, an 85% increase. So we got inventory going the wrong direction, dropping nearly 25% since the beginning of the year, where we sat at 2,530 homes, and we have demand increasing nearly 85% during that same period of time, which is essentially driving home prices up. But again, that doesn't tell the whole story because the 3-year average is normally 2,777 buyers in escrow during this time. So we're significantly below that level. In fact, we're at the lowest level since April of 2020. But because of that jump in buyer demand, we've actually seen the days on market drop from 84 days to 37 days, which is the first time we've been below 40 days since May of 2022. In fact, as you can see from this chart here, nearly 37% of the inventory is below $1 million. But here's the key, 56% of the buyer demand is in that same price point. You have more than half of the demand looking at a third of the homes out there. In addition to that, you have 29% of inventory being above $2 million. So the large majority of buyers out there can't buy that type of property. So once you factor that out of the total number of inventory, you realize how depleted the inventory is and why the housing market continues to be on fire. But here's the thing, the direction of the housing market is largely dependent on what happens to interest rate. You're at the current time in the market when we see the most inventory on the market. It's also a time when we typically see the most buyer demand. And we've seen inventory is down nearly 20% since the start of the year. And we've seen that buyer demand is down significantly from the 3-year average. So if this is the hot time in the market, what does that mean for the summer months? If interest rates move lower, you're likely to see some sellers put their homes on the market. Many sellers out there are locked into their homes because where interest rates sit currently. In fact, 90% of homeowners have an interest rate below 5%. 70% of homeowners have an interest rate below 4%. So many of those homeowners are locked into their homes. So if you see interest rates start to move lower, and they need to move probably into the mid 4% range to have a really big impact, but that's likely to bring some sellers off the fence. But at the same time, it's likely to create more buyer demand as well, because that means housing affordability is likely to improve with lower interest rates on top of giving them more choices to buy. But here's the thing, most people selling a home are also buyers of a property as well. Most people don't sell a property and then go rent. So it's almost a 1-for-1 exchange. They sell their home, they buy another home. So it doesn't really create any additional inventory, but hopefully it brings some reprieve for those buyers out there looking for the right home. But here's the catch. If interest rates continue to move higher, you're likely to see more of a stall in the housing market, which means year-over-year numbers are going to continue to disappoint. Month-over-month numbers could even disappoint. And with that, you're likely to lose some buyer demand, in addition to locking more sellers in their homes. The only people that are willing to sell in that market are those that have to sell. So what should you do if you're a buyer out there? You should continue to watch the housing market, continue to stay updated on what's going on, and buy when it's the right time in your life. Don't watch videos like mine and other videos and make your decision whether or not you should buy a house. Buy a house when it makes sense to you. In fact, that's the best advice I can give you. But if you have additional questions about the California housing market, do me a favor and check this video out here.